Hi, Assalamualaikum warahmatullahi wabarakatuh, and a very good morning. So, I hope you are doing well and have a good day today. Because today we will continue our class sessions with a new subtopics of returns and yield in property investment. So basically this topic will cover definition of yield, types of yield, income yields and total yields. So here you're going to learn on how to calculate yields, okay? Or sometimes also known as a rate of returns for the investment. Yield is defined as the ratio of benefits over the capital investments. Benefits is a returns or income from the investment, and then we compare with the capitals that we contribute at the early stage of investments. The return on investment is the ratio between returns of the investment with the capital outlay. And the property investments, the yield also known as the rate of returns or capitalization rate. Okay, so yield actually functions as a reward for an investors. Okay, of course, when you invest and you want it for the rewards, okay, for the benefits. So the yields, the returns, okay, essentially is the reward for an investor. Yield can be used to cover and reduce the risk of losing the money and the drop in inflation because by looking at the returns or yields, okay, so you can identify whether that particular investment is good to invest or not. Okay, so it will help investors to reduce the risk of losing their money in investments. Okay, so yields also function as a unit of comparison. Okay, so you can use yield to compare between one investment to another investment. So you can identify which investment is good. Okay, so you can use yield as a unit of comparison. Okay, to clearly understand the prices or value of certain investment. Okay, so yield normally, okay, presenting in the form of percentage. So this is the calculation of yield. Okay, so first you need to identify the income or returns, okay, from that investment, and then divide with the capitals, okay, the capital that you sacrifice at the early stage of investment, and then time with 100. Okay, so then you will get the result in the form of percentage. So that percentage comparing between income with the capital is called yield. Okay, so here is the examples, okay, on how to calculate yields and also how to determine the best investment comparing, okay, two investments, investment A and investment B. Okay, so here, okay, investment A give a return of 12,000 per annum and the capital is 100,000 while investment B can give a return of 10,000 and the capital is 80,000. Okay, so from your opinions, okay, so which investment that's a good investment here? Is it investment A or investment B? Okay, so okay, just keep your answers and then we will come back with the exact answer. Okay. Okay, so let's calculate the yield first. All right. Okay, so recap back on the formula. Okay, to calculate the yields, it is incomes divide with the capitals times with hundreds. Okay, so here income is the return for investment A is 12,000. So we divide with the capitals at 100,000. Okay, then time with hundreds. Okay, so for investment B, so we repeat the same process. Okay, so income is 10,000 and the capital is 80,000. So we time with 100. All right. So now we look on the results, okay, of yield. So investment A, okay, so the yield is 12,000 and 12.5 per 12,000, 12% and 12.5% for investment B. All right, so here, so which investment actually good, A or B? So the answer is B. Okay, the highest yield, okay, shows the good investment compared to the lowest yield. All right. So this is the yield in property investment. Okay. So actually, the yields for property investment, it tells an investor the amount of annual return that he or she is likely to get from the investment. Okay, like say, the investors rent out his property and he will get an income, monthly income, for example. And then that particular monthly income, and then we multiply with 12 months in order to get the annual income. So that particular annual incomes, will be then calculated to get the percentage of yield, okay, by dividing the rental incomes, yearly rental incomes with the capital outlay or um, the capital issued, okay, at the earliest stage of investment. All right. Okay, so then we look on the types of yield in property investments. Okay, so there are two means, okay, types of yield, so which is income yield and also total yield. Income yield is divided into three, which is the first one is initial yield, whereby it is a yield at the beginning of the property investment, okay, or is the yield that calculated for the current investments, whereby the yield is calculated by looking at the rental received, the current rental received, and then we compare with the capital invested in property, or maybe the cost for you to purchase a property, okay, all right, or the capital that you issued, okay, at the early stage of investment. All right. Okay, so second one is a revisionary yield. So this yield actually we calculated at the revisionary terms, okay, whereby we expected on the full rental value, okay. It is actually end of the the rental periods, okay, whereby okay at this time, okay, the investor normally expected for the rental value, and then to calculate the reversionary yield is by looking at the full rental value and we compare with the capital invested, okay, the cost that you spend, okay, to purchase a property. Okay, so the last one is all risk yield. Okay, so for all risk yield, okay, so it's actually the yield that has taken all the risk involved in property investment. So this is, we could say that this is the best, yields, okay, because it is already taken into consideration all the risk involved in property investment, okay. So in order to calculate the yield, so it is quite different. So compared to initial yield and reversionary yield, whereby all risk yield we will calculate by taking into consideration the full rental value and we compare with the capital value. All right, it's the current market value. All right, so that's the difference. Okay, so next one we have total yield. Okay, total yield is divided into two, which is equivalent and equated yield. So equivalent yield is more toward the total returns, okay, of the investment, whereby it's not taking into considerations on the changes of the rental towards the property. So we're not, considering on the rental growth of the property investments, okay. While equated yield, okay, so this one is opposed to the equivalent yield, whereby the equated yield, the we take into consideration on the um, rental change, okay, on the rental growth in the property investment. Okay. Okay, so this is the example. Okay, so we have a property A is currently let to a tenant with 5 years unexpired term at RM 30,000 per annum. This property was purchased at 400,000 and the current rental value of the property is 35,000 per annum. And then calculate the initial yield, reversionary yield, and or risk yield for this property. So the market value of the similar property at that area is at RM 450,000. So now I will show you the examples. Okay, so how to determine, okay, which one is the current rental value, which one is the full rental value or market rental. Okay, so which one is the um, capital invested and which one is the capital value or market value, right? All right. So 30,000, okay, if you read the sentence, property A is currently let to a tenant with 5 years unexpired term at 30,000 per annum. So this one is currently. So it means that it is a rental income, the current rental received. Okay. Then all right. This property was purchased at 400,000. So it is capital invested. Capital issued at the early stage of investment, whereby if you want to invest with the property, of course, you need to buy the property. So this is the cost that you spent before in order to get a property. All right. So next one is current rental value. Current rental value is the current market value, whereby even though the property is currently let at 30,000, but at the surrounding, okay, in the market, okay, the property was actually let at 35,000 per annum, right? So now you can differentiate between rental income and also current rental value. All right. So next one is capital value. So capital value is the current market value. Okay, even though you have bought that property at 400,000, but now today the value is 450,000. So that means the capital value also we call it as a market value. All right, so that's the difference. So that's how to determine. All right. Okay, so from that, okay, so we able to calculate the initial yield, reversionary yield, and also all risk yield. Okay. So first we look on the initial yield. All right. So the formula is current rental income or current rental received divided with the capital invested. So now our current rental received is 30,000. So the capital invested is 400,000. All right. So time with 100. So you get 7.5% of initial yield. All right. So next one, we calculate on the reversionary yield. All right. The formula is current rental value or full rental value. Okay. Divide with the capital invested. So what is our FRV? So it is 35,000. So our capital invested 400,000. Okay, so we divide that. So, okay, time with 100, then you will get 8.75%. Okay, and for the last on Oris yield, okay, so the formula is current rental value or full rental value, which is 35,000. So you need to divide with the capital value or market value. So our capital value is 450,000. All right. So just divide and time with 100, then you will get the average yield of 7.78%. So that's how to calculate. Okay. That's very easy. Okay, so there's notes here. In a conventional valuation, an initial yield is lower than the reversionary yield because of the current rental. Okay, is normally is below the full rental value. Okay, unless the property was rent out at the full rental value. Okay, however, the rental received and the rental value should be taken as net value. Okay, so you need to remember this. Okay, that's a very important issue. Okay, so to calculate the yield, so you need to determine, or you need to get the net rental. Okay, net rental received or net rental value. So how to get net? Okay, so this one, I think you have already learned before. Okay, during semester one. Okay, you need to deduct with the outgoings. All right. Okay, so this is the exercise. Okay, so just give you one exercise. Okay, a commercial property investment located in the city center led to a tenant at 6,000 per month gross for an unexpired term of 4 years. Was recently sold out at around 1 million, and it is estimated that property could fetch a rental value of 7,000 per month gross in the open market. And if sold with vacant possession, could fetch a price of 1.2 million. Okay, using the scenario, as I briefly explained, and calculate the different type of yields that can be associated with the property investment in this case. All right. So try and don't forget to submit to your lecturers, okay, in order to confirm whether your answer is correct or not. All right, so that's all for today. Thank you. Assalamualaikum warahmatullahi wabarakatuh. So we end our class with Surah Al-As and Tasbih Kifara.